There's a combination of tax consequences that could cost a senior homeowner $75,000 when they sell a residence they've owned for decades. Not because they cheated, not because they concealed anything, because of one innocent family decision most people have never encountered. I know a woman in Ohio who discovered this the difficult way. She owned her residence for 34 years. She sold it last year expecting to pay nothing in taxes. She'd resided there her whole adult life, raised her children there, paid it off years ago, a straightforward sale, a new beginning. She owed $23,400. And the decision that triggered it she made at her kitchen table on a Tuesday afternoon, thinking she was being responsible, thinking she was safeguarding her family. It took her fewer than 10 minutes. If you are over 60 and you own a residence, April 15th is the deadline that determines whether you can resolve this quietly or handle it the difficult way. And I mean that exactly as seriously as it sounds. I'm going to explain exactly what she did and why it matters for you right now. But before I get into it, a quick note. Everything I discuss today is based on current IRS rules and federal tax law, including the One Big Beautiful Bill Act signed into law July 4th, 2025. Nothing in this video is a substitute for guidance from a licensed tax professional. Use it as a starting point, not a final answer. Here is what this video addresses. 4 traps. 4 completely ordinary homeowner decisions that are quietly creating IRS problems for seniors right now. Then 3 things that could actually return money to your pocket on your 2025 return that most people over 60 have never learned about. Then a 7-step action checklist, including a free tool on the IRS's own website that reveals exactly what information they already have on your property. Most people only discover the traps. Very few discover the money they are leaving on the table. By the conclusion of this video, you will understand both. Do not leave early. The 4 traps spell out one word: home. H is for home equity mistakes. O is for ownership and deed changes. M is for move-out timing before a sale. E is for extra income from the property. Before we continue, if this is valuable today, please press the like button and share this with anyone in your life who is over 60 and owns a residence. That one share could protect someone from losing thousands of dollars. The people who need this most are usually the last ones to discover it. Now let me complete her story. Her name is Margaret. She is a fictional composite drawn from real situations tax professionals encounter regularly. Every person I reference in this video is the same. Real consequences, composite characters. Margaret's husband passed away a few years ago. Her daughter Sarah stepped in after that. Groceries, repairs, doctor appointments, everything. One afternoon, Margaret's neighbor suggested that adding Sarah to the deed would simplify things later. Avoid probate. Keep the residence in the family. It sounded like common sense. So Margaret did it. County Recorder's Office. Simple form. No attorney, no tax professional. No reason to reconsider. Here's what nobody explained to Margaret. When you transfer partial ownership of your residence to another person, even your own child, the IRS can classify that as a taxable gift. Depending on the value transferred, that may trigger a reporting requirement on Form 709. And when the property is eventually sold, the person you added to the deed may not qualify for the same tax exclusion you do, because they never resided there as their primary residence. Margaret discovered this 2 years later when her tax preparer reviewed her return and said 4 words she was not prepared to hear. We need to talk. Every dollar of that bill was preventable. The IRS does not consider why you did something. It only examines what you did and whether it was documented correctly. Good intentions do not appear anywhere on a tax return. So, let's examine the H home equity mistakes. Stay with me because this is where most people's attention drifts away, and that drifting away is exactly what costs them money. Most homeowners believe that if money came from their residence, it must be connected to the residence for tax purposes. That assumption is incorrect. Full stop. A senior borrows $40,000 or $50,000 against their residence through a HELOC. They use it to help a grandchild with college, cover a medical emergency, or pay down debt. And because it came from the residence, they assume the interest is deductible. It is not unless the money was used to buy, build, or substantially improve the property securing the loan. That is the rule under the Tax Cuts and Jobs Act of 2017. If the money went anywhere else, that interest is personal interest, not deductible. And claiming it incorrectly creates a gap that the IRS's automated systems are increasingly effective at identifying. Think back right now. Did you take out a home equity loan or open a HELOC in the last 3 years? Where did that money actually go? Into the residence or somewhere else? If it went somewhere else, you need a conversation with a CPA or enrolled agent before April 15th, because if that interest was handled incorrectly, there are steps available right now that become much harder after the deadline passes. And the O trap is the one that causes the most disagreements when I explain it, because people hear it and immediately say, that cannot be right. That is merely a family decision. I hear that every single time, and every time I respond with the same thing back. That is exactly why it is so dangerous. A senior adds an adult child to the deed for estate planning, probate avoidance, or simply because that child has been helping and it feels right. What feels like a family decision is also a tax decision, and those two things do not always align toward the same outcome. Think about the last 5 years right now. Has anyone's name been added to your property? A child, a grandchild, anyone? If yes, and no gift tax return was filed that year, keep listening because this next section is specifically for you. When you add someone to your deed without them paying fair market value, the IRS can classify that as a taxable gift. When the value transferred exceeds the annual exclusion limit, a Form 709 gift tax return is generally required depending on the structure of the transfer and your specific situation. If that was never submitted, that is a documentation gap sitting quietly in your history. And when you eventually sell, the person you added to the deed may not qualify for the primary residence exclusion, the provision that lets most homeowners exclude up to $250,000 in capital gains or $500,000 for married couples because they never reside there. Their share of the gain may be fully taxable. A sale that should have been tax-free becomes partially taxable over a deed change that took 10 minutes. I have spoken to seniors who discovered this at the closing table, not before the sale, not during the listing, at the closing table. Papers already in front of them. That is when they learned. There is also the basis issue. If you transferred the residence entirely as a gift, rather than leaving it as an inheritance, the recipient gets your original purchase price as their cost basis, not today's value. If you paid $80,000 and the residence is worth $380,000 today, they could owe capital gains tax on $300,000 when they sell. Had they inherited it instead, the basis would reset to current market value, and that gain would largely vanish for tax purposes. One path costs the family nothing, the other costs them tens of thousands. The only difference is the timing of the transfer. Now, that specific reason April 15th matters more than people realize. The IRS has an automated system called the Automated Underreporter Program. It cross-references your tax return against third-party data. Mortgage servicers, rental platforms issuing 1099-K forms, and property-related records. The gap between what you reported and what the IRS can see has been shrinking for years. Tax professionals are encountering more automated notices and more matching discrepancies than at any point in recent memory. After April 15th, if something hasn't been addressed, interest starts accruing automatically. Penalties stack. And the first-time penalty abatement program, A real documented IRS policy that allows taxpayers with a clean compliance history to request significant reduction or elimination of certain penalties becomes harder to use once assessments are finalized. The earlier you act, the more options you have. Now, the move-out timing. This is the one that affects seniors hardest, and it is the most misunderstood provision in residential tax law. Under IRS Section 121, to exclude up to $250,000 in capital gains from your home sale, $500,000 if you're married filing jointly, you must have resided in the home as your primary residence for at least 2 of the 5 years immediately before the sale. That is the 2 out of 5 rule. Here is where it quietly devastates people. Let me demonstrate exactly how this happens. And as I walk through this example, I want you to picture your own residence, your own address, and think about where you have been living for the last 3 to 5 years. You move in with your adult children because of a health issue, or into a smaller place while your house sits on the market, or you start renting it out while you wait to sell. All of these are understandable decisions. All of them affect your residency calculation. Say you moved in with your daughter in January 2021. You kept the residence, tried to sell, couldn't get the price, rented it for a year, and finally sold in March 2026. You moved out January 2021. Sale closed March 2026. That is more than 5 years since you last resided there. Under the 2 out of 5 rule, you may not qualify for the exclusion at all because both qualifying years fall outside the 5-year look-back window. If the property gained $200,000, you could owe capital gains tax on the full amount. For most homeowners in this income range, that is roughly $30,000. Not because you did anything incorrect, because retirement circumstances and a tax timing provision collided in a way nobody cautioned you about. There are partial exclusion provisions under Section 121C for health-related moves. They are real, but they require documentation and do not apply automatically. And here is something I want you to remember because Dorothy's story in a few minutes demonstrates exactly what happens when this trap combines with the next one. If you have moved out of a residence you still own and plan to sell, count the months this week. The window to address this exists right now. And now the E, extra income from the property. This is the one people dismiss first because the amounts feel small. That dismissal is exactly what makes it costly. A senior rents out a spare room, maybe through a short-term rental platform, maybe just to a college student, maybe a family member pays something modest to stay in the basement apartment. It covers the utilities. It feels like a practical arrangement. But the moment your residence generates rental income, any amount, any arrangement, the IRS treats that portion differently. 3 things change. First, that income must be reported on Schedule E. Informal arrangements are not exempt. No formal lease does not mean nothing to report. Second, a portion of your property expenses become potentially deductible against that rental income. But without documentation, you either face audit exposure or you overpay. Third, if you later sell the property, the rental portion may not qualify for the primary residence exclusion. The gain gets allocated between residential and rental portions. The rental portion can be taxed as a capital gain, and depreciation recapture under Section 1250, taxed at up to 25%, can apply to the rental portion even if you never claimed depreciation in the first place. That spare room you rented for $600 a month for 2 years can affect the tax treatment of your entire property sale. Not just that room, the whole transaction. Now, Dorothy is 68, Tennessee, resided in her property for 27 years. In 2022, a health emergency pushed her to move in with her son, Michael. Temporary, she told herself, to cover expenses while she waited to sell. She rented the residence to a young couple, $2,100 a month. She didn't report it the first year because her accountant had just retired and the software she used didn't ask the right questions. The following year, Michael added his name to the deed just in case Dorothy's health deteriorated. No gift tax return filed. Early 2025, Dorothy sells. 27 years of ownership. She walked into that closing expecting a clean, essentially tax-free sale. The IRS determined she had moved out more than 2 years before the sale. The rental period had changed part of the property's classification. The deed change created a gift reporting gap. The unreported rental income was a separate liability underneath all of that. Dorothy owed $23,400 across 3 separate issues, none of which she knew existed when she made the decisions that caused them. She wasn't negligent. She wasn't concealing anything. She was a 68-year-old woman managing a health crisis, a housing transition, and a family situation simultaneously without anyone explaining what she needed to understand. Dorothy did not fail the system. The system failed Dorothy, but the system does not adjust itself based on that fact. That is the whole reason this video exists. I want you to sit with that for just a moment because what comes next is genuinely different from everything we have discussed so far, and most people watching this are going to wish they had discovered it sooner. Now, the other side of this, because everything so far has been about problems, the next few minutes are about money you may be leaving on the table right now. Real money verified by the IRS, available on your 2025 return. The first is brand new and most preparers are not flagging it automatically. It is called the Senior Bonus Deduction, and it is part of the One Big Beautiful Bill Act signed July 4th, 2025. If you are 65 or older, you can now claim an additional deduction on top of whatever you already deduct. Whether you itemize or take the standard deduction, it stacks on top of both. Married with both spouses 65 or older, that doubles the total benefit. Available for tax years 2025 through 2028. It phases out starting at $75,000 modified adjusted gross income for single filers and $150,000 for joint filers. For many seniors in the zone where 50 to 85% of Social Security is taxable, this deduction pulls taxable income down enough to reduce that exposure. It will not eliminate Social Security taxation entirely, but it can meaningfully reduce it. For many seniors, that is $1,000 to $20,500 in real savings. This provision was buried in a 1,100-page bill. Some tax software has not been updated. Some preparers have not caught up. Ask your preparer directly, did you apply the senior bonus deduction from the One Big Beautiful Bill? If they appear confused, find someone who does not. The second is the SALT deduction increase. From 2017 through 2024, the state and local tax deduction was capped at $10,000. For homeowners in New Jersey, New York, California, Connecticut, and Illinois, where property taxes alone often exceed $10,000, that cap was burdensome. You paid the taxes. You received no deduction for the excess. As of 2025, that cap is now $40,000. For 2026, it is $40,400, increasing 1% per year through 2029. The phase-out starts at $500,000 in modified adjusted gross income, well above where most retired homeowners sit. Here is the problem. When the cap dropped to $10,000 in 2017, millions of homeowners switched to the standard deduction and never reconsidered. 8 years on autopilot. The cap has quadrupled. Their habits have not changed. If your property taxes plus state income taxes exceed $10,000, calculate the numbers again. Add your total SALT to your mortgage interest and charitable contributions. If that total exceeds the standard deduction for your filing status, you should be itemizing. If you already submitted using the standard deduction when itemizing would have saved you more, you can amend within 3 years. Do not leave that money sitting there. The third is the energy credit. If you installed solar panels, a heat pump, battery storage, or other qualifying energy improvements in 2025, The 30% federal residential clean energy credit is still applicable on your return for that installation. The One Big Beautiful Bill eliminated this credit effective December 31st, 2025. Systems installed and operational by that date still qualify. Systems installed January 1st, 2026 or later do not. The IRS has confirmed the cutoff is based on when installation is completed and the system is placed in service, not when you signed the contract or paid the deposit. If you have a 2025 installation and have not yet submitted, make sure that 30% credit is claimed. On a $30,000 system, that is $9,000 you do not want to leave behind. For future upgrades in 2026 or beyond, that federal credit is gone. Some states still have their own programs, but the 30% federal credit that millions counted on is no longer available for new installations. Now, this last one is different. It is not about your tax return at all. It is not about something you did incorrectly. It is about money departing your bank account every single year right now that you may be able to halt today with a 20-minute phone call. And there is one more thing most seniors have never been informed about. This one has nothing to do with the IRS. It is a state and local property tax benefit, and it varies by where you reside. But for many people watching this, it is worth more over time than anything else in this video. Almost every state in America offers a property tax homestead exemption for seniors. These are not minor discounts. In Texas, the over 65 homestead exemption alone can reduce your property's taxable value by $60,000 or more on top of the standard homestead exemption, saving some homeowners $4,000 to $6,000 every single year. Florida freezes your property tax assessment at the value it was when you first qualified, meaning even if your neighborhood doubles in value, your property taxes do not increase. Georgia offers full exemptions from school taxes for qualifying seniors. New York, Pennsylvania, Ohio, Illinois, almost every state has a version of this. Here is why this should make you genuinely frustrated. These exemptions are not automatic. Nobody sends you a letter when you turn 65 saying your taxes just decreased. You have to apply. You have to visit your county assessor's office or appraisal district, complete a form, provide proof of age and residency. If you have been 65 or older for years and never applied, you have been overpaying. Some states allow retroactive applications going back 1 or 2 years, meaning you could receive a refund on taxes already paid. Contact your county appraisal district this week. Ask what senior property tax exemptions are available. Bring your ID and your deed or a recent tax statement. It takes about 20 minutes. And for many people watching this video right now, that contact will save more money over the next 10 years than anything else discussed here today. Now, before the checklist, 60 seconds on something that has nothing to do with taxes. It has to do with protecting yourself from people who will use everything you just learned against you. Every tax season, scammers target senior homeowners aggressively. Phone calls, emails, people pretending to be IRS agents saying you owe money right now and will be arrested if you do not pay by wire transfer or gift card. The real IRS does not call you demanding immediate payment. The real IRS does not accept gift cards or wire transfers. The real IRS does not threaten arrest over the phone. The real IRS communicates through official postal mail with a notice number in the upper right corner of every letter. If anyone contacts you claiming to be the IRS and creates urgency around immediate payment, hang up, delete it, report it to the IRS phishing reporting page at phishingears.gov. The issues in this video are real. The people attempting to exploit your concern about those issues are also real. Understand the difference. Now, the action checklist, 7 steps this week. Step 1. Pull your last 3 years of tax returns. Review Schedule A for mortgage interest. Check for Schedule E. Rental income appears there. Search for any 1099 connected to the property. Anything missing or unexpected, document it. Step 2. Locate your deed. County Recorder's Office can provide a copy online for a small fee. Verify every name listed. If a name was added in the last 5 years and no Form 709 was submitted, that needs professional review before April 15th. Step 3. Map your residency timeline. If you have moved out of a residence you still own, calculate how many months since you last resided there as your primary residence. If that number is at or past 24 months and you have not sold, obtain professional review before the sale closes. Step 4. Check your IRS account transcript at irs.gov. Create a free account. 15 minutes, you will see every notice on file for your account and every piece of third-party data the IRS has matched to your Social Security number, including 1099-K data from rental platforms. If the IRS has information about your property that does not match your return, you will see it there. Knowledge is the only thing that provides you options. Step 5. Track your home equity records. Locate documents for any HELOC or home equity loan. Note down exactly what those funds were used for. If they went into the property, you likely have a clean paper trail. If they went somewhere else, your return may need review. Step 6. List every rental arrangement the property has had. Any amount, any arrangement, dates, and amounts. A tax professional can determine what was handled correctly and what needs to be addressed. Step 7. Contact a CPA or enrolled agent this week if you have any uncertainty after steps 1 through 6. The National Association of Enrolled Agents has a free directory at naea.org. Search by location and specialty. When you call, ask specifically whether they have experience with IRS penalty abatement for real estate issues. That one question reveals immediately if they are the right person. Dorothy completed none of these 7 things, not because she was careless, because nobody provided her this list before she needed it. You have it right now. Use it. The cost of a professional review is almost always smaller than the cost of the problem it was intended to prevent. Let's bring it all together one final time. The 4 home traps. H. Home equity. Money from your residence is not automatically sheltered under IRS rules. O. Ownership changes. Adding someone to your deed is a tax event whether you intended it to be or not. M. Move-out timing. The 2 out of 5 rule does not pause for retirement or health transitions. E. Extra income. Rental income from your residence changes its tax classification, and that change follows the property all the way to the sale. The 4 things working in your favor right now. The senior bonus deduction available on your 2025 return. The SALT cap at $40,000 if you are in a high-tax state and still on standard deduction autopilot. Calculate the numbers again. The 30% energy credit for 2025 installations that have not yet been submitted, and the senior property tax homestead exemption sitting unclaimed at your county appraisal district that could save you thousands every year. If even one of the 4 traps sounds familiar, do not store this away as something to consider later. That is exactly how Margaret ended up hearing those 4 words. That is exactly how Dorothy ended up owing $2,400 on a sale she expected to be straightforward. Start with step 1 tonight. The deadline is April 15th. By then, what could have been a quiet resolution becomes a scramble, and scrambles are expensive. If this video helped you, press the like button right now. Subscribe if you are not already here. Share it with anyone over 60 who owns a residence. And drop a comment below. Which one of these did you not know about before watching? That question genuinely helps me decide what to address next. And your answer might be the topic of the following video. In the next video, I'm going to walk through Form 709, the gift tax return that most seniors never submitted when they changed their deed, and demonstrate exactly how to address that gap before it becomes a formal IRS notice. If Margaret's situation sounded familiar when I shared her story at the beginning of this video, that next video is specifically for you. It is already on your screen. Watch it now, because this is exactly the kind of topic where waiting costs you more than acting.